YouTube family, welcome back to another video. And in today's video, I want to break down, how would I say it? I want to break down business lines of credit to where you understand it from an advanced perspective, not the general way that most gurus online are talking about it, and they have you going out getting products that does not fit your business's growth. So in today's episode, we're going to break down what we're going to call B-Lock mastery. And if you tap into this channel, we don't take this lightly. You must be up to date with the latest data, understanding what product is going to serve you and your business for overall best financial growth. Because you don't get in business just to stay mediocre. We get in business to scale and provide our loved ones, friends, etc. with the lifestyle that we desire. So, with that being said, family, sit back, enjoy yourself, and get a notepad because this one is going to be in depth to where you understand what you're getting into whenever you sit down and talk to that banker. Most people are applying for business lines of credit completely wrong. They see a lender say up to 100,000, up to 250,000, even up to 500,000, and they automatically think that the biggest number is the best deal. But banks do not think like that. Banks are not just looking at how much money they can give you. Banks are looking at the overall risk, also known as risk mitigation. They are looking at the repayment capacity. They are looking at collateral. They're looking at, the personal guarantees. They're also looking at how your business is structured, how your cash flow moves, and how the line itself is going to behave once you start using it.
Entrepreneurs, business owners, anybody that is struggling with access to maximum exposure with your personal credit cards, business credit cards, structuring your LLC or corporation. It's a multitude of things that you are missing out on, stopping you from getting access to your first $100,000 at 0%. And what I want to do is coach you to your first 100,000 or your first million. No matter where you're at, you're going to get value from my $99 community where we break down everything from personal credit mastery, business credit mastery, travel hacking mastery, manufacturer spending mastery. Nothing is left off the table in this community. Listen, for only $99 a month, you can come and sit down with me and hundreds of other entrepreneurs and business owners and ask me rapid fire Q&A. How much would that be worth to sit down with a multi-seven-figure business owner to answer your questions? Most people say it's worth thousands, but I want to grant you access for only $99 a month, and you can cancel anytime with no pushback. I'll see you on the inside, and in my words, everybody eats. Let's go.
So in this video, I don't want to just give you a list of business lines of credit. I'm going to be honest with you, that's way too surface level. What I want to do is show you how to think through business lines of credit like a strategist. Because a business line of credit is not just a funding product, it is a liquidity tool. It is an underwriting signal, and whenever it's structured correctly, it can become one of the most valuable relationship products your business has with a bank and or credit union. But whenever it's structured the wrong way, it can create liabilities that most people don't even understand until they're already inside of the repayment schedule. So sit back, enjoy yourself, and this one's going to be good. Here is what I want you to understand from the beginning. The line of credit is not the flex. I see multiple people online saying they got approved for $250,000 line of credit, $300,000 line of credit. The structure of the line is the real flex. If every time you draw money, that draw turns into a separate loan, that is going to be beneficial for you to know. If every draw has its own repayment schedule, that's going to matter. If the lender files a UCC against your business asset, that matters as well. If the line is secured by all business asset, that also matters. Because at that point, you did not just get liquidity, you accepted a liability structure. And if you are trying to build business credit the right way, trying to position your company for bank funding, real estate liquidity, inventory, payroll, acquisitions, or just stronger cash flow, you have to know the difference. So this video is going to be a full breakdown of business lines of credit from the data point level. We're going to talk about the maximum exposure. We're going to talk about unsecured amounts. We're going to talk about collateral and UCC1 filings. We're going to talk about which products behave like true revolving lines and which products treat each draw more like a separate loan or individual loan. We're going to talk about docs. We're going to talk about the bureau pools. We're going to talk about the exact questions that you should ask a banker before you apply. Because that's one thing that we do. We audit banks and we make the banks compete to lend us money, family. So understand, the goal is not to just get approved. The goal is to understand what you are getting approved for. Start with the biggest misunderstanding. Most people compare business lines of credit by asking one question: how much can I get approved for? What's the most amount? That is the question everybody asks first, but that is not the best question, because a bigger approval is not always a better structure. A larger approval can move into a different underwriting category. It can move from unsecured to secure. It can move from collateral requirements. It can trigger UCC filing. It can create a blanket lien against your business assets. It can also put you into a product where every draw behaves like a separate loan instead of a revolving balance. So instead of asking only how much can I get, I want you to ask better questions. The first question: is the line truly revolving? That matters because a real revolving line should allow you to borrow, repay, and reborrow without turning every draw into a brand new loan structure. A clean line of credit should also give you reusable liquidity. Also, a clean line of credit should give you reusable liquidity. The second question is, does each draw get treated as a separate loan? That matters because if every draw becomes its own loan, now you may be dealing with multiple repayment schedules, timelines, and repayment obligations running at the same exact time. This is not the cleanest version of a bank style line of credit or what we like to leverage. The third question is the line unsecured under a certain amount? That matters because unsecured and secured credit are not the same conversation. When a lender says the line is unsecured up to $100,000, that gives you a strategic lane. But when you go above that threshold, the lender may require collateral, a UCC1, or maybe take a position against the business's assets. The next question is, what documents are required? That matters because prepared borrowers are lower risk. If you have your business information, the revenue, the tax returns, the statements, ownership information, and borrowing purpose ready before you apply, you show up differently. Understand this: banks do not just approve ambition, they approve files. And then the fifth question is this: which bureau is likely to be pulled? That matters because hard inquiries affect sequencing. But we have to be careful here. A lot of lenders do not officially publish the exact bureau they will pull for a business line of credit. So bureau pool information will vary by geolocation at times. So you could be in New York and they pull a specific bureau. You could be in Texas and they pull a specific one. So the bureau data can help with planning, but it should never replace direct verification before applying ever. So if you are watching this, I want you to shift how you think. Do not just ask who gives the most money. Ask, what is the structure? What is the threshold? What is the collateral requirement? What is the repayment terms? What does this do to my future bankability? This is how you stop moving like a consumer and start moving like a true business owner. Now, for this specific video, I am using 4 product filters because I don't want you to put every product that says line of credit into the same exact category. This is where a lot of people get confused. Just because the product says a business line of credit does not mean it behaves the way you think a business line of credit should behave. So here are the filters. Filter number 1, the product should be revolving. That means the business can draw money, repay the balance, and reuse the available credit. That is the whole point of a line of credit. It should be flexible liquidity. Filter number 2, the product should not treat every draw as a separate installment loan. This is very, very important. If every draw creates a separate loan, then the product may technically be marketed as a line of credit, but the repayment behavior is different. Filter number 3, the product should be ideally unsecured at or below the target approval amount. And for several lenders, the key range is about 100,000. That does not mean 100,000 is universal law. It means that multiple lenders use that range as the line between unsecured small business credit and more collateral lending. Filter number 4 is the relationship should have value behind the approval. This is why I care about banks and credit unions. If you are only chasing fast money, you may accept fintech funding. And if you're in that space, it's not a bad thing, but just know what you're getting into. But if you're trying to build bank positioning, banking relationships, you need to think differently. You need to ask, how will this line look inside the banking ecosystem? What did I pledge? What did I personally guarantee? What does this lender relationship do for my next funding deal? That is the difference between getting funded and building a funding strategy. Now, let's get into the steak and potatoes of it, because you know I say everybody eats. Let's jump into 10 business lines of credit I want to break down for you. And I want you to listen carefully to how I frame these. I'm not saying every one of these is perfect. Some are cleaner than others. Some give us strong official data points. Some are relationship bank options where you need to ask more questions before you assume the line is unsecured or a no UCC. That is the whole point of this training. We are not just collecting names. We are learning how to evaluate structure. The first one is PNC's unsecured small business line of credit. This is one of the cleaner examples because the product is specifically positioned as an unsecured small business line of credit. The published range on PNC's website is $10,000 to $100,000. The clean unsecured threshold is basically the product itself because it caps at $100,000. PNC states that collateral is not required for this product. The line can be accessed through checks, online transfer, or phone transfer. Strategically, I would grade this as an A because it lines up very well with what we are talking about in this video: a clean unsecured line, a clear $100,000 ceiling, and a true revolving structure. The lesson with PNC is simple. If the lenders gives you a clean unsecured lane, respect that lane. Do not let ego make you ask for something that pushes you into a different underwriting conversation. The second one is US Bank's Cash Flow Manager. This one is important because US Bank gives us one of the cleanest threshold lessons. The published range is $10,000 up to $250,000, but the unsecured line limit is $100,000. That matters. Trust me. Because US Bank also states that secure applications require a UCC lien and that the bank must retain the first lien position. So this is not just a product. Under $100,000, you may be in the unsecured conversation. Above that, you may be walking into secured territory, UCC territory, and lien position territory. The line can be accessed through a card. It can be accessed through checks, online banking, and different branch access. Strategically, I would grade this US Bank, I would give it an A. It's not an A plus. I would give it an A because the product gives us the exact distinction people need to understand. Requested amount is strategy. The third one is Fifth Third's business line of credit. Fifth Third gives us another strong $100,000 example. They have an unsecured option from $10,000 up to $100,000, and for that unsecured option, no collateral is necessary for the approval. For higher borrowing amounts, Fifth Third moves into a secured line where the business may need to pledge short-term assets like accounts receivables and inventory. So again, the $100,000 line shows up. This is why I keep telling people that the number you request matters. A lot of business owners and entrepreneurs think they're being smart by asking for the highest possible amount. But sometimes the smarter move is asking for the highest amount that keeps you inside the cleanest underwriting lane. So strategically, I would give Fifth Third, maybe I would give them like an A minus because the unsecured threshold is clear. The collateral distinction is easy to understand. The fourth one is Santander's conventional business line of credit. Santander is another strong example because the collateral language is very simple. The conventional line ranges from 10,000 to 250,000. The unsecured range is 10,000 to 100,000. The secured range is 100,000 to 250. And Santander says the secured business lines are generally secured by all business assets. This is the sentence I want you to pay attention to. All business assets. That means we are not just talking about a small technical detail. We're talking about a lender potentially taking a broad position against your business. So if you're trying to preserve clean bankability for like future funding rounds, you need to know whenever you are crossing from an unsecured line into a secured line. Santander has a 1-year revolving term with annual renewals and interest-only monthly payments. Strategically, I would grade this like an A- because the product gives clean data, but the secured threshold needs to be respected. The fifth one is Bank of America's business, I think it's the Business Advantage credit line. Bank of America markets this as an unsecured revolving business line of credit. The line starts at 10,000. The unsecured product does not require collateral, and Bank of America separates that from the secured options that may involve a certificate of deposit or a blanket lien. This is important because the bank is showing you that all credit lines inside the same institution are not structured the same exact way. One product may be unsecured, another product may be secure, another may involve a lien. This is why you cannot just say, I got a line with BOA and assume the structure is clean. You need to know which product, which amount, which collateral requirements, and which renewal terms applies to the line that you get. Strategically, I would grade BOA as like an A- as well. It's a strong relationship bank option, especially for borrowers with clean personal credit, established revenue, and a strong banking profile. The sixth one would be Wells Fargo. Wells Fargo published this as an unsecured revolving line of credit. The range is 10,000 to 150,000. The product can be accessed through checks, transfers, bill pay, and card access. But here's the nuance. Requests over $100,000 are handled through a relationship manager or branch. That does not automatically mean the product becomes secure, but it does tell you something important. When the application path changes, the underwriting conversation may change. This is why I teach people to pay attention to the thresholds. If an application is simple, up to one amount, but then requires a banker above that amount, you need to ask more questions before assuming the structure stays the same. Strategically, I would probably give Wells Fargo an A- as well because it's a mainstream unsecured revolving line with, I would say it's easy access, but the over $100,000 path needs to be clarified before you apply. Please note the data points before you apply for any product, not just with Wells Fargo. The seventh one, and this is a great personal bank, by the way, but the seventh one is Navy Federal's business line of credit. Navy Federal's line starts at 10,000 and it is a revolving balance line for operational needs. But this one is more nuanced. Navy Federal states that the line must be secured for amounts over 100,000. Sometimes the accounts receivable collateral can require an all business assets lien. So Navy Federal can be powerful, especially for eligible members, but this is not like a lazy application. This is not the kind of product where you just click a button and hope for the best. You will need documentation. You will need tax returns, financial statements, business financials, personal financials, and a clear understanding of the collateral. Navy Federal is super strict, especially on the business side whenever we're going for large lines of credit. So strategically, I would give Navy Federal, I would give them, let's give Navy Federal a B+. And y'all let me know in the comments what you think. It is strong, but the borrower needs to be prepared and needs to understand the collateral threshold. Please do not go into branch without knowing this information. The eighth one is TD Bank's small business line of credit. TD describes this product as a revolving line for frequent business expenses like inventory, payroll, and operation needs. TD allows Online applications for small business loans and lines of credit under $250,000. The line allows borrowers to pay down and reuse the credit, and there is an interest-only payment option. That is good, but here is the caution. The page does not clearly publish a no collateral threshold or UCC threshold, so I would not teach TD as a guaranteed no UCC play. I would teach it as a relationship bank option where you need to ask the banker directly, at this amount, is this unsecured, collateral required, or will a UCC be filed? Strategically, I would give TD Bank a B. Good revolving structure, but you need confirmation before you assume it is the clean line strategy. The next one I would do is the Citizens Bank business line of credit. Citizens describes the line as reusable. You can borrow multiple uses, pay it back, and borrow against it as needed. Interest is charged only on the funds used. Citizens also says borrowers can get a business loan or line of credit up to $250,000 in 2 to 3 days with larger requests handled by business bankers. That speed is attractive to most people, but speed is not the same thing as clean structure. The page does not clearly state that the unsecured threshold or the UCC policy. So Citizens may be a strong option, but I would still verify the security, collateral, and UCC treatment before applying. Strategically, let's give them a B minus. It's good reuse and speed, but you need banker confirmation on the collateral side. That's very important. Now, last but not least, the 10th one is KeyBank Small Business Line of Credit. KeyBank publishes lines of credit from $10,000 up to $500,000. It also includes secure and unsecured options with renewable 12-month terms. But the issue is that the review page does not publish a clean unsecured cap or UCC threshold. So KeyBank gives you a strong ceiling, but your job is to find the clean lane inside that ceiling. Do not just hear 500,000 and get excited. I know you did. Like, how many of us got excited? We heard 500. We're like, bro, I can put this into real estate. I can put this into stocks. I can put it in multiple places. And you got excited. Ask what happens at 50,000. Ask what happens at 100,000. We then ask what happens at 150,000. Ask whether the line is unsecured or secure, and ask whether a UCC will be filed. Strategically, I would give KeyBank a B minus because it has strong relationship bank potential, but you need to clarify the structure before you treat it like a clean unsecured play. Now, I want to add one example here, and that is Chase. Chase is a major bank, and Chase offers a real revolving business line of credit. The range is $10,000 to $500,000 for existing Chase business customers. It has revolving access for 5 years, possible renewal, and then a repayment period after the access period ends. But the reason I'm treating Chase as a contrast example is because Chase says it only offers secured lines of credit. So Chase is not bad. Let me just be clear and let you know that. Chase is not bad. But if the whole purpose of this video is clean, unsecured business liquidity, Chase is not the example I would give unless a banker gives you the product-specific confirmation that your file is being handled differently. That is the level of detail I want you to start thinking with whenever we are applying for really any type of financial product, not just business lines of credit. Now, with all of that being said, family, let's talk about the products that I would avoid or have major caution for this specific strategy. And I want to be very clear about how I am saying this. I'm not saying these companies are scams. I am not saying nobody should ever use them. What I am saying is that they do not fit the clean bank style line of credit strategy we are talking about in this specific video. Some of them may solve short-term cash flow problems. Some may be useful for speed. Some may be easier to qualify for, but easier does not always mean cleaner. The first one that I would avoid for this specific strategy is American Express. And I know this may surprise some people because Amex is like a respected brand. But this is why we read structure, not logos. Amex states that each draw on the line results in either a separate installment loan or a separate single repayment loan. That means every draw can become its own loan. So for this strategy, that fails the filter. It may still be useful for someone who understands the terms, understands the fees, and needs short-term capital, but I would not teach it as a clean bank style revolving line of credit. The Amex product says a line of credit, but structurally, every draw can become its own loan, and that is very important. The second one I would avoid for this strategy is Fundbox. Fundbox is very clear in its own help center language. It states that each draw acts like an individual loan. That's the sentence. Each draw acts like an individual loan. So again, this may be useful for a business that needs quick working capital, but it is not the clean revolving bank line structure I am teaching in this video. That is loan stacking behavior inside what many people casually call a line of credit. Like most people are getting these products because of how they're marketed, but they don't truly understand. And if you do not understand that before you draw, you can create cash flow pressure very, very fast. The third one is Blue Vine, and I would put this into the caution category. Blue Vine offers a line of credit up to $250,000. I know y'all hearing these amounts and you like, bro, if they give me $250, I'm turning up, right? But Blue Vine is issued by Celtic Bank and serviced by Blue Vine. One thing some people may like is that Blue Vine reports repayment history to Experian Business Credit. That can be very useful, but the repayment mechanics are still draw specific and fixed schedule. So Blue Vine is not necessarily a full avoid, but for this training, it belongs in the caution category because it is not the cleanest bank style revolving line. It may be useful for speed. Do not get me wrong. It may be useful for quick access to cash, but you need to understand what? The repayment behavior. Listen, y'all, I'm teaching you how to think like a strategist here. If you want general credit knowledge, you can go to some other YouTube channel, but here we get strategic. Fourth one is On Deck. On Deck offers revolving business lines from $6,000 up to $200,000. They publish repayment terms of 12, I think it's 18 or 24 months with weekly or monthly payments. On Deck also states that it does not charge annual fees, monthly fees, or draw fees. That's a positive. So I'm not putting On Deck in the same category as something that clearly says every draw is a separate loan. But for this specific strategy, I would still treat it cautiously. The reason is that the draws carry set repayment terms and scheduled payments. That makes it feel more like a fintech working capital than a clean bank positioning line. It may solve a problem, but it may not build the kind of bank profile we are talking about. I would just say this. Anytime a line of credit makes every draw feel like a new repayment agreement, slow down, read the terms, because the product name is not enough. I want you to understand what you're getting into whenever we are auditing these banks going for funding, because it's much different whenever we're going for business lines of credit and business credit cards. Now, let's talk about bureau pools. I want to be very careful here because this is where a lot of content creators get reckless. Most official lender pages do not clearly publish the exact bureau they will pull for a business line of credit. They may tell you there will be a personal credit check. They may tell you a personal guarantee is required. They may even tell you that credit worthiness will be evaluated. But the exact bureau is often not officially stated. So when we talk about bureau pools, we need to separate official requirements from community reported tendencies. Based on public bureau pool data that is mostly focused on credit cards, Bank of America is often associated with TransUnion for business products and Experian for personal products. Chase is commonly associated with Experian. Citizens is commonly associated with Equifax. KeyBank is commonly associated with Equifax. TD Bank is commonly associated with Experian. US Bank business products are often associated with TransUnion, though sometimes Experian appears whenever you are applying for certain products depending on your geolocation. Wells Fargo is commonly associated with Experian, and in some cases, Experian plus Equifax, depending on the state that you're in. That's why I say geolocation is super important. But I want you to hear me clearly. That is directional data. That is not a guarantee. The Bureau can vary by state, product, underwriting channel, relationship, and whether the application is online or banker assisted. So if you are sequencing your applications, we don't guess. We ask the questions. And if the banker cannot confirm it, we treat the Bureau data as a possibility, not as a promise. Now let's talk about infamous documentation. This is where a lot of people lose before the bank ever makes a decision because they think the application is the strategy. The application is not the strategy. The file is the strategy. A prepared borrower looks different. A prepared borrower sounds different. A prepared borrower makes the underwriter's job much easier. And when you make the underwriter's job easier, you usually create a better environment for an approval. Now, I want to give you a simple framework to think through all of this. I call it the 5C credit filter, right? This is how you stop looking at lines of credit like a borrower and start looking at them like someone who understands underwriting. And the first C is capacity. Capacity asks, can the business repay from revenue and cash flow? This is where revenue, deposits, profitability, and existing debt matter. Hype does not repay a line of credit. Cash flow does. The second C is character. The character asks, does the borrower have clean personal and business credit behavior? This includes your personal FICO, the payment history, inquiries, utilization, business credit behavior, and even banking conduct. Banks are looking for patterns, and if your file shows discipline, you are easier to trust. The third C is collateral. Collateral asks, is the line unsecured or secured by business assets? This is where you need to understand thresholds. This is where you need to know whether a UCC filing could happen because this is very important. A UCC affects future funding approval. This is also where you need to know whether the lender is taking a specific collateral or a broader position against the business. And the fourth C is the conditions. The conditions ask, what is the money being used for? A strong use of funds makes sense inside the business. Inventory, payroll, receivables, equipment repair, short-term working capital, those are real business uses, and uncertainty creates risk. So the fifth C is control. Control asks a multitude of questions. Does the borrower understand the repayment mechanics? This is where most people miss. They get approved, but they do not understand the structure of what they just borrowed. We don't do that. We understand what we're getting into, not solely from the line or the amount, but truly how the product operates and if it serves us for business growth. And most people draw money, but they do not understand whether the draw is part of one revolving balance or whether it becomes a separate loan. They accept the line, but they do not understand whether the lender filed against business assets. Control means you understand what you are signing before you ask for the bag. That is credit mastery. Now, let's come back to the $100,000 rule. This is one of the most important parts of this video. I'm not saying $100,000 is universal law. I am not saying every lender handles it the same exact way. But when you study these products, you start to see a pattern. PNC's unsecured small business line goes up to $100,000. US Bank's unsecured cash flow manager line goes up to $100,000, while secure applications can involve a UCC lien. Fifth Third has unsecured lines up to 100,000 with no collateral necessary. Santander has unsecured lines from 10,000 to 100,000 and secured lines from 100,000 to 250,000. Navy Federal says business lines must be secured for amounts over 100,000. So the $100,000 range is often the line between small business unsecured credit and more collateral driven commercial underwriting. Again, not always, but often enough that you should respect it. If you want cleaner positioning, the requested amount should be intentional. Sometimes, like, let's just be honest here, family. Asking for $75,000 or $100,000 is smarter than asking for $150,000 if the larger request moves you into a secured lane or UCC1 lane. This is why I say requested amount is strategy. The biggest approval is not always the best approval. The best approval is the one that gives you liquidity while preserving future fundability. You do not ever want to go out and get access to 150,000 and then that stops you from getting access to an additional 300,000. We must be strategic anytime we walk into a financial institution. Before you apply for any business line of credit or any funding product, I want you to ask better questions. Do not just walk in and say, "What can I get approved for?" That is not how you control the conversation. You want to ask questions that reveal structure. The first question is, at my requested amount, is this line unsecured or is it secure? That matters because you do not want to assume the product is clean just because the marketing page sounds very simple. The second question is, will this bank or credit union file a UCC1 financing statement? That matters because a UCC filing can put the lender's claim on public record and it will affect future funding rounds for your specific business. The third question is, if the line is secure, is the lien tied to specific collateral or all business asset? That matters because there is a big difference between a specific collateral position and a blanket lien against a business. The next question I want you to ask is this: is this a true revolving line or does each draw create a separate loan? That matters because this one question can save you from misunderstanding the entire product. We now move into what is the minimum payment structure. This matters because you need to know whether the line behaves like interest only, a percentage of the balance, or just amortized debt. The next question, super important, is what documents will underwriting request before final approval? The reason why this matters is because you want to prepare before the bank starts asking. Preparation creates confidence. The next question we ask is, does the bank report the line, and if so, to which business bureaus? The reason why this matters is this: if you are building business credit, reporting behavior matters. Another question you must ask is this: is the line reviewed annually, and what can cause a non-renewal? That matters because a lot of lines are not permanent. They can be reviewed, they can be renewed, they can be reduced, they can even be frozen in certain instances. So you need to understand what the bank expects after approval, not just before approval. These questions separate you from the average borrower. The average borrower is asking for money. The strategic borrower asks about the structure. So here's the big takeaway. Business credit mastery is not about collecting random approvals. It is about understanding how institutions classify the risk. A borrower who knows the difference between a true revolving line and a draw-by-draw loan is already ahead of most business owners. A borrower who understands unsecured versus secured, specific collateral versus all business assets, and bank relationship value versus fast fintech money is moving strategically. That borrower is not just applying for money. The borrower is managing credit, let's just say credit architecture. I like the way that sounds. And that is the level I want you to start thinking on, because the best line of credit is not always the largest line. The best line of credit is the line that gives you liquidity, protects your positioning, and keeps you attractive to the next lender. That is how you use credit as leverage. That is how you build business profile banks want to compete for. And that is why we make the banks compete to lend you money. Y'all let me know what y'all thought about this. Drop comments, drop questions, drop concerns. Let me know what you need from me next. And in my words, everybody eats. Peace.